Hi, and welcome to our end of October update from the Wealthy Doctor Institute. Physicians leading physicians through finance. We work with physicians and other busy professionals who are not happy with the current investing strategy. We help them get this part of their lives handled so they feel empowered and in control. I'm David Ye, and in my book, The Busy Doctor's Investment Guide, I show just a few ways where just a few adjustments each year can help build and protect wealth. Although the strategies in this book are easy to calculate each month, for those who are new to the concepts in the book, or for those who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So in this month's video, we'll look at the Busy Doctor's update for the month, topic of the month, review our strategies starting with the 20-month moving average strategy, review the MRI system, remind ourselves of the rules for the 25% stop loss system, and then monitor the free sector server strategy that comes with any sector server subscription. So let's get started. So day in the life of a busy doctor. So even though I semi-retired 4 years ago, life continues to be busy. The good news is at UIC we finally have our new chief of nuclear medicine. He's credentialing and orienting well. I think we're in good hands. Meanwhile, managing the startup of this business still takes a lot of time. In addition to spending time with family, such as, for instance, this is Halloween, date that I'm recording this. And then the next month, I'll be doing a lot of traveling. First to the AAI meeting in Florida, and then back to Florida again for the Tony Robbins Unleash the Power Within event, which I highly recommend to anyone who's never been before. But despite the busyness, I still easily place trades indicated by my systems. They literally require mere minutes to see and execute. So the topic of the month, continuing self-education. Just like last month, I was introducing the topic of continuing self-education, kind of like CME, only for life skills and relationships. And the reason why I bring this up again, because for fellow busy doctors and busy professionals, we can read during net time. In other words, no extra time. In other words, audiobooks. And this month, for the question of the month, what are you currently reading? I just finished the book, The 100-Year Life by Linda Grattan and Andrew Scott. It's very interesting perspective. I mean, you think about it, life expectancy has been increasing an average of around 2 years for every decade that's been passing. And right now, people our age, around half a century years old, we're expected to live to around 80, 85 years old. Now, when I talk to residents and medical students, they're going to be easily living to 90, 95 years. Now, we've hinted this before, from our standpoint medically, there is going to be explosion in geriatric growth and geriatric care that will be needed in this country. People are surviving longer. People who in the past would have died from the first heart attack are now surviving 3 or 4, including 2 or 3 cancers where usually one would be a death sentence. But it's also a myth that old age necessarily means frailty. And this is a global thing. This book cites examples from overseas, for instance, the UK or Japan, where their sovereigns give gifts to centennials, and these gifts have been exploding in recent years. And we've mentioned before the potential financial crisis of so many centennials, not just needing healthcare, but not saving enough just because it used to be we only needed to save for maybe 5 years of retirement. Now, retirement can easily last 30, 40 years, which is basically more than our entire lives, which means we're living longer in retirement than we are actually working. And in order to accumulate some kind of critical capital mass to support that type of life for so long is very challenging. But what really caught my ear about this book is that it introduces the concept of phases of life in a different twist. For instance, normally, if someone were to say they were an undergrad, or if someone were to say they were a senior manager, you would kind of expect roughly what age group these people fell into. But more and more, these stereotypes are no longer applying. It used to be we had only 2 phases of life: childhood and adulthood. More recently, we've had 4: childhood, adolescence, adult, and retire. But in order to live a 100-year life, we have to face the reality that we're living multi-phase lives now, where we habitually switch careers as interests and skills develop and evolve, where support systems evolve. But one thing is clear: if we don't adapt, the gifts of those extra years can be a burden, not just to ourselves, but to our families and society. But change must start with ourselves. So take a look at this book. They bring up many very thought-provoking points. So now let's review our systems. So our systems objectively look at footprints of every trader invested in the markets and let the markets tell us what to do. So for our first system is the 20-month simple moving average system, abbreviated to 20-month SMA system for our slides. So the rule here is you calculate the 20-month moving average. If the price of the S&P 500 index is above the 20-month moving average of this index, then it's relatively safe to stay invested in index fund comprised of the S&P 500 index. Otherwise, get out. The 20-month moving average is our safety belt. It only works if we watch it every month. So here's a graphical representation of our 20-month moving average for this month. So the VFINX, which is the Vanguard S&P 500 Index Fund, the fund I use because, number one, it's the longest fund with the most data available. It's also a relatively low-cost fund. At the end of the month, it ended with a price of $237.96 per share, and its corresponding moving average is 210.08. So divide, just for curiosity's sake, we see that we have a 13% cushion. In other words, as long as the stock stays above this moving average, and in fact it can fall 13% and still be above this moving average, we're still a relatively safe zone. But remember, if at the end of next month this stock index actually drops more than 13% and ends up below our moving average, then that's a danger signal and we should get out with this system. So the observations for this month for the 20-month moving average, their indicator continues to signal relative safety in the US stock market. Both the S&P 500 index and its 20-month moving average has increased to a point where the S&P 500 index is outstripping 20-month moving average. Last month we were 12.4%, now we're 13.3% above the moving average. Now, if you're saying that the safety cushion of 13% isn't that great, well, remember, the system is not designed to catch peaks. Markets must fall enough for a system to fulfill criteria for a danger zone. This also means that if the markets become relatively volatile in the coming months, it can be volatile up to this month and still be in our safety zone. So here's Sector Surfer's version of trying to differentiate between dangers and safe for stock market, using their StormGuard Armor filter, switching between the same stock and bond mutual funds. We see that according to StormGuard Armor, we're still safely in the stock phase. And so here's the StormGuard Armor indicator. We're still in relatively safe zone. So the next system is our monthly rotation investment system, abbreviated to MRI. The rules: every month we take 3 mutual funds, the S&P 500 Index Fund, the Emerging Markets Fund, and the Inverse S&P 500 Index Fund, and we rank them. Whichever one did best, we sell the bottom 25% of our portfolio and buy that top fund. We repeat once a month. So here's a graphical representation of how our system is doing this month. So here's last month's data, this month's data. The S&P 500 index went up 2.3%, whereas inverse went down 2.2%. But if you take a look at emerging markets, it went on a tear. It beat our US stock market up until around the middle of the month, and then it started to slowly drift down. However, still ended up higher than our US stock fund, going up to 2.4% compared to the S&P 500 2.3%. So this month's winner is the emerging markets. So this is what we do. Last month, we were roughly 75% in the emerging markets, 25% in the S&P 500 index. This month, we're supposed to sell the bottom 25%, which is the S&P 500 index, and buy the top fund, which is the emerging markets fund. So we're effectively 100% in the emerging markets starting this month of November. So here's Sector Surfer's version of rotating MRI funds. According to Sector Surfer, we are actually still in the emerging markets. No change from last month. Now remember, Sector Surfer uses a different rotation algorithm than I describe in my book. It's still a variation on sector rotation. The formulas are a little bit more sophisticated on this side, but remember it's different enough that it's a different system. Don't mix up systems. So, observations of the month. The emerging markets continue to outpace the U.S. stock market until around the mid-month. Although it still ended up beating the U.S. stock market, momentum seems to be weakening for now. We'll see. Again, let the markets tell us what to do. Don't try to anticipate the markets. Sector Surfer continues to be in the emerging markets. Remember, Sector Surfer uses a different algorithm. Don't mix up the systems. And just because two different systems agree does not mean it's a sure thing. If the markets were to change within the near future, in other words, mid-month next month, each system will have a different criteria to exit and switch. So watch your system, whichever one you're using. So the next system is the 25% trailing stop loss system. The way this one works is that if you really want to buy single stock, for instance, rather than a fund or ETF, you can limit total risk of that one stock to your just 1% of your portfolio by doing this following maneuver. You only use 4% of your trading account to buy that stock. Immediately enter a 25% trailing stop loss order. This way, if the stock drops 25%, you only lose 1%. Now true, a stock can potentially gap through and you lose more than 1% of your portfolio, but in general, if you have a trailing stop loss order where the stop loss keeps going up more as the stock goes up, but doesn't go down when the stock goes down, at least you have this semblance of a safety belt. So, if the stock goes up 33%, the stop loss has essentially broken even. You can go ahead and use another 4% of your account to buy more stock, and then update your trailing stop loss order to reflect the increased number of shares, and repeat until stopped out. So the next system is your own Sector Surfer system. I can't tell you what your Sector Surfer system did or signal. You have to monitor your own. Usually Sector Surfer will text or email you, but you have to set it up properly. Just this past month, we had a client of mine who didn't notice a signal until I tapped her on the shoulder and said, "Hey, did you take a look?" So remember, make sure you set up the system so that you get these alerts. If not, then at least log on once a month, or at least once a week rather, to make sure you're not missing any signals. Now, the way Sector Surfer works is that it improves on classical pie chart investing if we structure it correctly. So Sector Surfer has two main goals. It uses a method to differentiate between when it's relatively safe or dangerous to be in the stock market, and then if it's relatively safe to be in the stock market, it rotates among up to 12 stock funds, and if it's dangerous to be in the stock market, it rotates up to among 12 bear market funds, which can be a combination of bonds, cash, and inverse funds, typically just bonds. We can combine the two into our system that is more robust, but again, if you make your own system, at least back-test it to make sure that it does what you think it's supposed to be doing. These are just some nuances when constructing a strategy. So with Sector Surfer, you will get a signal if set up properly. Log on periodically to make sure you don't miss any trading signals. I log on once a week just because I manage several clients who have different strategies, so this way I don't miss anything. And for this month's free strategy, Number one, it remained in the safer stock zone. And number two, it remained in the Fidelity Small Cap Stock Fund as a dominant stock fund. So here's how it looks like. For those of you who are subscribing to Sector Server, you get this free strategy. I'm not giving away anything by updating you with this, but we remain in the small cap stock fund here. So in summary, remember, we went over different systems. Don't mix them up or mix them together. If you switch between systems or do not take action, you have no system. We reviewed the 20-month moving average system, monthly rotation investment system. We reviewed how to deal with stock tips using that 25% stop loss system. And then we reviewed Sector Surfer in general with that free Sector Surfer strategy that we're monitoring. So keep those questions coming. I know I talk to several of you personally each month, and realize that for some of you, these video updates are not enough. Especially if you're still unhappy with your current investing strategy or lack of strategy. I'm going to offer a complimentary investment wellness checkup and breakthrough session for you, just you and me. Ask all the questions you want, no matter how seemingly basic or clueless you think you are. In our checkup and breakthrough session, we'll together create a sense of clarity about the financial future you really want, the reasons you're investing to begin with, and how to get you there. Discuss investing building blocks that are more specific for your situation. Determine what has stopped you in the past from getting what you want now. Identify what are the more important steps you'll need to take now to get to your investing and financial goals, and then complete our consultation with the excitement of knowing exactly what to do to create that road to the future you really want. Think CME, only the topic is financial and tailored to you. Think wellness checkup, because whether or not you feel financially well, if you had a financial cancer or blind spot you didn't know about, wouldn't you rather at least know so you can deal with it before the problem grows and metastasizes? Don't be bashful reaching out. The more you delay, the more time is against you. So, until next month, invest safely.